So 15.2 is continuing what we learned in 15.1 with our income statement. As a quick review on our income statement, on the very top we have our revenue section. Revenue, we do sales, then you do less sales discount, less sales returns and allowances, then you have net sales, that is your words. Then you switch over to your cost of goods sold. Cost of goods sold section, you're going to start with your merchandise inventory January 1st. Merchandise inventory January 1st is your trial balance number. With that, you're going to go through and do your purchases. But purchases need to move over because then you have to find your net purchases. So you have to do less purchases, returns and allowances, less purchases discount, and then you will get your net purchases. You're going to add your purchases to your beginning inventory, and that's going to get your total merchandise available for sale. Your total merchandise available for sale, you're going to subtract your merchandise inventory on December 31st, which is your merchandise inventory number on your balance sheet. Subtract that off, and that is going to give you your cost of merchandise sold. Cost of merchandise sold, subtract from your net sales is going to give you your gross profit on operations. Okay? If I am going to sell you this nice dry erase board for $2, okay, I didn't make this. My cost of goods sold, let's say, is 75 cents. What is my gross profit on operations? $1.25. That is the concept of what we just did on the top portion of your income statement. You just have more numbers to get all of that because I just did it per item. You need to do it for everything that you have within a business. Then in the bottom part of your income statement is your expenses. You do all of your expenses except for your federal income tax because you have to have on there your net income before federal income tax, subtract your federal income tax expense, and then you're going to get your net income after federal income tax. That number needs to equal what's on the worksheet. If it doesn't, you know somewhere you've made a boo-boo. Find and fix. Ask me to help. I like to help. Last thing we did is that far right column, those percentages where you take everything and divide by sales. Yes, divide by net sales. Now, we are going to look at those numbers. That's what 15.2 is all about. Okay? So when we look here, Interstate Tire determines that no more than 53 cents or 53% of each sales dollar should be devoted to the cost of merchandise sold. So we need to compare the actual component percentage for cost of merchandise sold to their acceptable. So the business has already said, this is what we will find is acceptable. Okay? Compare the actual component percentages for the cost of merchandise sold to the acceptable percentage. And then you need to indicate if the actual component percentage is acceptable or unacceptable. If it's unacceptable, you have to suggest an action to correct it. That is what accountants do. Accountants don't sit and fill in income statements all the time. You're going to have a bookkeeper that will do that type of work. Accountants look at the information, analyze it, and make recommendations. But an accountant can't just look at the numbers unless they understand where it comes from. That's why we're learning that. Okay? So I want you to realize accountants don't do what we're doing all the time. That's not their job. But they have to understand it to help businesses make better decisions. So this one is a little bit different because when we take a look at our cost of merchandise sold is actual what? Do you see it right here in our worksheet or our income statement? 51. What is acceptable? Okay, so no more than 53. So is it acceptable? Yes. Okay. Now you have to read if it says no more or no less. And this one said no more. So we're going to go ahead and I'm going to move this out of the way. So the actual component percentage I'm going to put in is 51.9. Nope, that's the wrong number. Yep, no, I did it right. 51.9. Sorry. And then it has to be no more than 53. So is it acceptable? Yep. Yeah, so I'm going to put a check mark in there, a V. Turn the numeric keypad on. You learned something today. Okay, now number 2. Acceptable auto part industry standards show that at least 47 cents or 47% of each sales dollar should result in gross profit. For Interstate Tires, we're going to compare the actual component percentage for gross profit on sales to the acceptable percentage. Indicate if the acceptable percentage is acceptable or unacceptable. If it's unacceptable, suggest an action to correct it. Okay. So, they said here, not less than 47. Where are we at?
48.1.
Yep, gross profit on sales, 48.1. So I have to put that here. So it says not less than. Is it less than 47?
Yeah.
It's greater than. So it's acceptable? Yes. So we're good to go. Both of these numbers are okay. So I don't need to put everything over here to take an action. Now, the next thing that we have to do is we have to talk about stockholders. Okay? We are dealing with a corporation. Corporations are owned by stockholders. Okay? When a business has a net income, stockholders get money. No different than when we did our service business organized as a sole proprietorship. When the business was done, the owner got all the money. Now, a business can decide if they're going to put everything back to their stockholders, or they're going to save some in retained earnings because they're going to build a new plant, or they're going to buy new equipment, they're going to get a new car, whatever it may be. So they're going to decide what they're going to give back to their owners, and then they have to go through and divide it by how many shares of stock have been issued. Every business is going to have a different amount of stockholders. Mm-hmm. No. It is not a corporation. No. We do give away a scholarship, though. Okay? So, when a business becomes a corporation, in their articles of incorporation, which is a legal document that they create, they go through and they say how many shares of stock are going to be issued for the company. Okay? There could really be 3 shares of stock. Yes, so if I go into we make a corporation right here, there's going to be 3 shares of stock. 1, 2, 3. We are not a publicly traded company. You can still be a corporation and not be publicly traded. Okay? Now, Apple is a corporation and it's publicly traded. If you wanted to buy Apple stock today, could you? Yes. Okay? Now, interesting fact about Apple, if I go and buy a share of Apple stock, who gets that money? No. Whoever I bought the stock from. Okay? So, I want to buy a share of Apple stock. Michaela owns a share of Apple stock. I buy it from her. The only time Apple gives money if they issue new stock. But anytime stock is bought and sold, it does not necessarily go back to the corporation because you're buying it from whoever previously owned it. Now, corporations can go through and issue more stock as a way to generate funds for future endeavors, but that takes then the value of the whole company and divides it over more people, so sometimes that's not a good idea. Okay? So just as a heads up. So in instruction number 3, it says Interstate Tires currently has 110,000 shares of outstanding stock with a market price of $13.75 per share. We need to calculate the earnings per share and our price earnings ratio. Okay? We have to multiply and divide. I know. So let's go through and do our earnings per share. So you need to know this formula. This formula is not hard. You take your net income after federal income tax and divide by the number of shares outstanding. So our net income on our income statement is $62,907.35.
What about recommended?
You only fill that out if you accept no.
Oh, no, I already clicked one.
Oh, actually, I think you have to choose none or it'll mark it wrong. Okay, so $62,907. How many shares of stock do we have? 110,000. That was easier to say this time. Yes, net income after federal income tax. So, divide that. What is your earnings per share? Yes. Okay, what is the value of stock? How much does one share of stock go for? No. Mm-mm. If I wanted to buy $13.75, okay, it says it in the directions. So, Interstate Tires here that we're dealing with, if you wanted to buy one share of stock, it's going to cost you $13.75. So, are people going to buy one share of their stock? No, you're probably going to own multiple. And here's the thing, there are 110,000 shareholders. If I take my total net income and divide it by my shareholders, that would mean each shareholder gets 57 cents. All publicly traded companies do this with their net income, and it's going to be called the earnings per share. So each share of stock then gets 57 cents. So now we have to calculate our price-earnings ratio, and our price-earnings ratio is taking your market price and divide by your earnings per share. So my market price was given to us in the directions of $13.75. Earnings per share we just calculated, 57 cents. Break out your handy-dandy calculator. Yep.
You get about 27, 28.
No, it's 6,000.
No, I think 28.
I'll give it 24.12.
It's not 24.2. That's embarrassing.
What is your
28.
24.1, you're going to do 1%.
What?
24.1.
Isn't 13 plus 13 like 16? You're not adding. Yeah, but divide. 13 plus 13.
Yeah, it's 0.6.
Oh, yeah, it's 0.6.
You're probably wondering how I did that.
No, you're an idiot.
Okay, so you will be expected on the test to be able to calculate earnings per share and your price-earnings ratio.
You're silly.
Okay, now, I don't like this work together example because there is no option where it says no for us to take a look at what you would say. So let's go ahead and click on save and do on our own together.
Wait, do what?
Let's do on your own together. So, this is exactly the same, except our component percentages are different, so we need to talk about what action will we take. So, for Osborne Corporation, so we have the acceptable game industry shows that no more than 30 cents or 30% of each sales dollar should be devoted to total expenses. Compare the actual to the acceptable. So, they have on there no more than 30 for total expenses. What is their total expenses?
34.8.
34.8. So, is it acceptable? It's not acceptable, would you agree?
No.
Okay. Now, I want you to look here. Otherwise, you're just going to look at the drop-down menus and not know which one to choose from. Okay? So I want to explain how you make the next choice. When I look here, I am looking at 34.8. Correct? 34.8 is my total expenses divided by what? Net sales. If I need to change this number, this 34.8, I need to change one of two numbers, right? I either change this number or I change sales. To make this number acceptable, I need to make this number go down. So, I can do two things. I can make sales go up, or expenses go down, right? That's the only way that you're going to make this number acceptable. Can a business just go walk out and declare and say, we are going to make sales go up next year?
I wish that.
That's a little bit harder, would you agree?
I don't agree.
Is it easier for them to say, we're going to go through and cut back on employees, and we're going to have less expense for payroll. But they can do that, right? They could go through and say, well, let's spend a little bit different on advertising. Let's go through and install low-flow toilets so we spend less on utilities. Right? Would those things adjust and make your expenses lower? Well, I don't know if you want to get rid of advertising, because if you reduce advertising, what's going to happen to your sales? Sales will go down. Less people will know about your business. So when we look here, we have two options: increase sales or decrease expenses. So this has these choices to pick from. Two of them talk about expenses, but only one works. Reducing expenses will increase net income in this percentage. No, wrong. It's got to be this one, because that's what we're affecting. Okay. Now, we take a look at net income before federal income tax. There is an industry standard that says it should be at least 15% of each sales dollar should result in net income. So we have to go through and compare. Now, you will notice our net income before federal income tax is 12.3, so I got to plug that in there. Now, it says not less than 15. Is it less than 15? Acceptable or unacceptable?
Unacceptable.
Okay.
I think I know what the answer is.
Hang on.
It's identify the lower cost.
If changes in purchasing or pricing policies will increase this.
Identify ways of reducing.
Why would we reduce it when these people?
Okay, so when I take a look at my net income, okay, this 86,000, this component percentage 12.3 is figured out by doing what? This number
divided by the top.
by my net sales, right? How did I get this number, this 86? I took expenses minus my gross profit on sales. So, to change this number, I need to change this one, or I can change this one. Agreed. Now, to change this one, I could change my purchases, and the cost of merchandise sold is purchases, or I can change my sales. So as you move down, you have more options of things that you could adjust to go through and make this number acceptable. So to change my 12.3 to make it higher, I can reduce my expenses. Agreed? The other thing I could do is I could make this 329 number go down. To make the 329 number go down, which is my gross profit on sales, I could go through and reduce how much it costs. So here's my example. For the Thunder Zone, instead of every month buying one case of cookies, the beginning of the year I say, okay, I want 4 of each one, and then I get bulk pricing. Bulk pricing means I get each cookie a little bit cheaper. Same product. I just got to make sure that I use it in an efficient time manner so it doesn't go bad. Is that a way of reducing my cost of goods sold? Yes. I could also see if I find another vendor that offers me the same product but cheaper. Or maybe I don't want this product, I'm going to switch to another one. It's similar, but it costs less, and therefore I can make more money. Now, peanut butter. Okay? Peanut butter companies are making more money now. Why? The cost of the price that you pay for peanut butter is not changing. Melina, do you know what I'm talking about? We've talked about it in marketing.
More people are buying peanut butter.
Nope. She's like, no, I'm stumped.
Jelly prices are going down.
Nope. Do you know that you get less peanut butter in a jar? When you go there, No, it's not peaked at the top. The actual bottom of a jar of peanut butter is convex, meaning it's not flat. Peanut butter jars used to be flat.
Oh, yeah. And there used to be a cylinder.
Okay? So, they didn't change the whole size of the peanut butter. They did that, but it's marked clearly how much peanut butter you get in a jar. But you don't notice a difference because the jar of peanut butter looks the same. The other thing they're doing is, if you take a look at a box of cereal, they're changing the depth of a box of cereal. Instead of it being this wide, now they're skinnier. So it's the same size, so you look at it and it doesn't seem like it's smaller until you grab it from the side. That's another way that a business can reduce its cost of goods sold, because they're actually going through and giving you less product but charging you the same price. But how they do it is a little bit different. Right? So now the next time you look at a bottom of peanut butter, you'll be like, that's how they do it. Not all peanut butter, but if you look at like Jif and Skippy, you're going to find those. It's noticeable in the bottom. When you get to the bottom of your container, you're going to notice that it's not flat. So it's okay. So net income before federal income tax. What are we going to say? What do we have to do?
All right, changes. Correct.
Changes in purchasing or pricing policies will increase this. I got a feeling I'm right on this one.
Sorry, my mouse is just sliding down my screen by itself.
Changes in purchasing or pricing policies.
I'm not touching my mouse.
Will increase this percentage. You gotta identify ways of reducing your cost per connected.
Okay.
Let's arm wrestle for this.
We are going to go with the reducing expenses will increase net income.
You called me dumb right when I told you that.
I don't know. Okay, so that's how you would change those two. Now, let's go through and calculate our earnings per share. We do it exactly the same thing. We put in our net income after federal income tax of $68,609.37. How many shares of stock do we have?
8,000.
Oh, so less shares of stock for this company.
So
So when we go through, we have $8.58 per share of stock. Our market price is $104.50. Earning per share is going to be $8.58. So your price earnings ratio is 12.2. Okay, so,
You know what's some good
all right,
chips?
work together, 15.3 is available. This one is not very long either, okay? Not.
Still pickle, dude. Come on.
So,
Still pickle chip.
gentlemen,
Barbecue? You like barbecue?
Michaela, can I come up by you and get away from these guys?
I love you too.
This is a statement of stockholders' equity. Now, in our first unit for our financial statements, we prepared a statement of owner's equity, and there was one owner. So all the money went right to the owner. Now we have stockholders. So we have to go through and figure out how much money we're keeping and how much money we're giving to the stockholders. So when we take a look at our statement of stockholders' equity, you will notice that we have 3 columns. So our income statement has 4 columns. Our statement of stockholders' equity has 3. And on the far right-hand column, again, your goal is always to get your totals. The very heading of our statement of stockholders' equity is always the name of the business, the name of the document, and the date. A statement of stockholders' equity is always prepared for the entire fiscal period. We never say, on today, May 23rd, this is what it is. We say, this is what it is for the whole time. Okay, so we're going to go ahead and do this for Interstate Tire. Statement of stockholders' equity, and it is for year ended December 31st.
Okay, good. Wow.
Now, couple pieces of information we need from the directions. Gentlemen, please calm down. It says, prepare a statement of stockholders' equity for the current year. As of January 1st, So we're preparing this on December 31st, but they're saying on January 1st, they had issued 100,000 shares of capital stock. But as you recall and work together, how many shares of stock were issued in that example? 110. It's the same business. So we have to talk about something there. And they were issued with a par value of $1 per share. During the fiscal year, the corporation issued an additional 10,000. Remember when I talked about that example? So January 1, they had 100,000. Throughout the year, they issued another 10,000, and they had additional shares of capital stock. So when we take a look at here, this gives us our net income information that is going to be used on our statement of stockholders' equity. So the very first thing that we have to do in the very top, we're going to fill in a heading here called capital stock. Okay. Now I'm going to have to look. I don't remember if the test has these words filled in or not. If they don't, you should put it on your note card. Okay. Now, they have it filled in right now. It says capital stock. They issuing their stock for $1 per share. So if you were to buy the share of stock directly from Interstate Stire, they're going to charge you $1 a share. So January 1st, they went through and they had 100,000 shares issued. So we are going to do the math. So the total value of stock right here is going to be what? 100,000. Multiply 1 times 100,000. Now, it says here, issued during the year was an additional 10,000. What is the value of those additional 10,000?
10,000.
1 times 10,000, which is 10,000. Add them up. So our balance on December 31st of 110 shares issued is 110,000.
Good call. Did you get what I got?
Now, capital stock actually deals with the number of shares of stock that's issued. Our next part is retained earnings. Retained earnings is the amount of money that a business keeps from its net income in order for it to run and be profitable. So that's my next heading there, is retained earnings. Now, it asks for the balance on January 1st of retained earnings. You are going to get this from your worksheet. If you scroll down, below your income statement is your worksheet. And you will find your retained earnings on line 26. You will notice my trial balance and my balance sheet column has exactly the same numbers. $46,599.48. Now, the next line that comes is, it says net income after federal income tax. I get that right here from my worksheet, $62,907.35. That goes in the first column because I have to do math. The next line, it says dividends declared. This one, you'll have a hard time. Now, what are dividends? Yes, exactly. So a business goes through and declares that they're going to pay money to the stockholders, and they set an amount. It doesn't have to be the whole net income. It's just going to be a portion of it. So how much did Interstate Tires say that they're going to pay to their stockholders?
14,000.
No. Where'd you find it? So if you look on your worksheet for the account called dividends, nope, not dividends payable.
Dividends receivable.
Oh, it's 2,200.
There's one worksheet.
Oh, it's 2,200.
It is not 2,200. It is not dividends payable. That's not the account I said. Right here, line 27, the account is dividends.
Oh, you tricked me.
8,800. Dividends is like drawing. Okay? Keep that in mind. So, dividends declared is going to be $8,800. Now, notice my words right here. It says net income less. So I have to subtract $8,800 from $62,907. And that's going to give me $54,107.35. You will notice 54, this is a positive number. Would you agree? So therefore, of the total net income, $54,000 is going back to the value of the business for our retained earnings. So right here it says net increase. Could this say net decrease? How? If this isn't a net income, if it's a net loss, it would actually be a net decrease to your retained earnings. So we know we have a net increase of $54,000. So I'm going to take $46,000 plus 54, and that's going to be my new balance on December 31st of $100,706.83. My total value of stockholders' equity is my retained earnings plus my capital stock. You will now notice I'm on the far right column. So I need to add my capital stock and my retained earnings to give me my total stockholders' equity, which should be $210,706.83. That is how you prepare a statement of stockholders' equity. It's easy if the things are there. I will let you know on the test if you have to have it or not.